All right, let's unpack this. The human story, at its heart, is this constant quest for meaning and order, right?
Right.
And nowhere is that clearer than in the structures we build to manage resources and trust, especially, well, our financial systems.
Yeah, absolutely.
Today, we're taking a deep dive into the intricate comparison between the established, centralized financial world that the U.S. and global systems you interact with, like every single day, and that emerging decentralized paradigm of Bitcoin and DeFi.
And for this deep dive, we've really gone through your stack of sources. The mission here is to extract the core insights that help us understand how both human and increasingly AI perspectives on these systems shape just about everything.
Everything.
Pretty much. Individual lives, history, beliefs, culture, the environment. It's about dissecting how differing views on what has value and how we exchange it, well, how that ripples through life and circumstance.
And here's something cool. AI isn't just a topic we're exploring. We're also looking at it as a potential lens to help us clarify these super complex interactions, and maybe even a tool to navigate or reshape them based on what we saw in the materials you shared.
Exactly. We're setting the stage for a real journey here, drawing from economics, philosophy, history, tech, ethics, psychology, arts, the environment. It's truly interdisciplinary, just as your sources presented it.
Right.
The goal is to give you an AI-informed explanation, analyze the effects these systems have, and suggest potential areas for improvement, all rooted in the materials you brought.
This is your deep dive. We know you're curious to really grasp the deep-seated mechanisms governing how humans interact with systems that assign and distribute value, and how AI might fundamentally alter that dynamic. So let's jump in.
Well, one of the first things that stands out in the materials you shared is how traditional financial systems didn't just spring into existence. Their evolution has been strikingly reactive.
Right. It wasn't some grand, proactive design plan for the perfect global system. Your sources show how it really started taking shape in the late 19th century, significantly pushed along by the first big wave of globalization.
Like technologies like the transatlantic cable dramatically speeding up communication and, increasing global migration. That really kicked things off.
And as your materials highlight, that early system quickly revealed its vulnerabilities. World War I, for instance, effectively paralyzed markets, and the Great Depression saw widespread retreat into protectionist policies by nations. Big shifts.
Yeah, huge shifts. And specific crises, as you pointed out in your stack, were often the catalyst for major changes. Take the Panic of 1907 in the U.S.
Okay.
Your sources show how that specific event directly influenced the Federal Reserve Act of 1913, creating a centralized monetary control and a formal lender of last resort. It was the direct reaction to instability.
Okay, so fixing a problem, not building from scratch.
Precisely. And following World War II, there was another massive restructuring with the Bretton Woods Agreement, which pegged currencies to the U.S. dollar, convertible to gold.
Right.
That period also gave rise to key international bodies like the IMF and World Bank, again, a system built in response to the chaos of war and economic instability.
But even Bretton Woods wasn't permanent. Your sources trace how the 1970s, with oil crises and currency devaluations, led to the dismantling of that fixed exchange rate system and the move to floating currencies.
So a key insight from your sources about traditional finance is this pattern. Its evolution has been driven by reacting to crises and technological shifts, rather than a proactive, designed approach.
Right.
This means its stability is something that has to be actively managed and negotiated. It's not an inherent feature.
So building on that, how does this massive reactively evolved system actually work today? What are the core pieces that make up its engine room, as your sources put it?
Your materials detail the fundamental components. You have the intermediaries, the financial institutions like banks, credit unions, investment banks, those guys in the middle.
Okay, the institutions.
Then there are the markets where assets are traded, stocks, bonds, commodities.
Right, where the buying and selling happens.
Yeah. You have the financial instruments themselves, stocks, bonds.
And the payment systems, the underlying infrastructure, and crucially, the regulators like the Fed, the FDIC, and the SEC here in the U.S., plus central banks globally guiding monetary policy. They're overseeing it all.
Exactly. The core principles, according to your sources, are about mobilizing savings, facilitating investments, managing risk, discovering prices, forming capital for businesses, and enabling monetary policy.
Yeah.
All those functions.
From your perspective, you interact with this system every day as a borrower, getting loans or using credit cards, as a lender, depositing money, and as an investor, buying stocks or bonds. It's just life.
And the role of those U.S. institutions is critical from that user perspective, as your sources emphasize. The Federal Reserve influences the interest rates you pay or earn.
Big impact there.
Huge. The FDIC ensures your deposits up to a certain limit, which your materials highlight as a key mechanism for maintaining public trust.
That safety net feeling.
Exactly. And the SEC regulates the markets you might invest in, aiming for fairness and transparency to protect you.
And at its heart, this system relies on intermediation institutions acting as the go-betweens, channeling funds from savers to borrowers. That's the core mechanic.
Which naturally leads to centralization. Your sources discuss how orders are typically routed through single exchanges. Clearinghouses are used to reduce counterparty risk.
Like making sure the other side pays up.
Right, and even internal company finance functions often adopt a financial shared services, FSS, model for consolidation. Everything funnels through central points.
The rationale for that centralization is clear from the materials.
Yeah.
Efficiency, standardization, compliance, scalability. Makes sense from a business perspective.
It does. However, a critical insight your sources raise is the trade-off. While centralization offers institutional benefits, it also creates systemic vulnerabilities, single points of failure, cascading effects when things go wrong.
Right, dominoes falling.
Exactly. And for the end user, it can feel opaque and disempowering, a sentiment that was very strong during the 2008 crisis. This inherent tension is precisely what your materials show made an alternative so appealing.
And that alternative, of course, was Bitcoin. Its emergence is directly linked to that 2008 crisis and the loss of faith you just mentioned.
Absolutely. Bitcoin was conceived in the immediate aftermath of the global financial crisis. Your sources position it as a direct response to the perceived failings of the traditional system and a distrust in centralized authorities.
Satoshi Nakamoto's white paper, released in October 2008, is presented in your materials as the foundational blueprint. Bitcoin, a peer-to-peer electronic cash system. Pretty bold title.
It really was. That document, as your sources detail, laid out the core concepts. Decentralization, no single entity in control. Peer-to-peer transactions directly between users.
No middleman.
Exactly. A public, distributed ledger known as the blockchain, security achieved through cryptographic proof, eliminating the need to trust third parties, and a balance between pseudonymity and transparency.
The explicit purpose, as articulated in the white paper your sources cited, was to solve the online double spending problem without relying on intermediaries, to enable faster, cheaper global money movement with maximum individual control. It was truly envisioned as digital cash.
That vision was powerful, but the technology is what turned it into reality. It's the engine.
And delving into that tech, as your materials do, is key to understanding how Bitcoin achieves that trust without institutions. How does it actually work?
A crucial insight from your sources is how the core technological pillars essentially replace traditional institutional functions algorithmically. First, decentralization. The network is maintained by distributed nodes across the globe, making it highly resistant to censorship or shutdown, unlike a central server.
So no one could just unplug it.
Pretty much. Then there's the blockchain itself, which your sources describe as the shared, immutable, and transparent ledger. Transactions are grouped into blocks, and these blocks are cryptographically linked together in a chain. Once a block is added, changing it becomes incredibly difficult, like digital snow.
Super evident, right?
Exactly. Cryptography is fundamental. Asymmetric encryption uses public and private keys for addresses and signatures, ensuring only the rightful owner can authorize spending. Hash functions create fixed-size outputs, used for linking blocks securely and as part of the mining process.
And to get everyone on the network to agree on the ledger's state and prevent fraud, like double spending, Bitcoin uses a consensus mechanism, specifically proof of work, as detailed in your sources. How does that work?
Well, it involves participants, called miners, competing to solve a complex computational puzzle by hashing block data until they find a result below a network-set difficulty target. It's like a lottery, but with processing power.
Okay, a really hard lottery.
Yeah, very hard lottery. And that difficulty target, your sources explain, automatically adjusts roughly every 2 weeks.
Why?
It's genius because it keeps the average time it takes to find a new block consistently around 10 minutes, regardless of how much computing power is competing. Keeps the rhythm steady.
Oh,
yeah. The first miner to find a valid hash gets to add their block to the chain and receives newly created bitcoins as a block reward, plus any transaction fees within that block. This process secures the network and is how new coins are introduced. Key fields in the block header, your sources note, include things like the previous block's hash, the Merkle root summarizing transactions, a timestamp, the difficulty target, and the nonce, that's the number they changed to find the hash.
So the big takeaway here, based on your sources, is that these technologies collectively replace the validation, record-keeping, and security functions typically performed by financial institutions. Trust shifts from trusting an organization to trusting verifiable code and distributed computation.
Exactly. It's a fundamental shift in where the trust lies.
Okay, so Bitcoin really pioneered the peer-to-peer cash idea, but decentralized finance, or DeFi, which your sources delve into, represents a major expansion of those principles beyond just money.
Right. DeFi aims to rebuild and even enhance a wide spectrum of traditional financial services, lending, borrowing, trading, insurance, using blockchain and smart contracts, but critically without relying on the traditional intermediaries like banks.
Trying to do everything banks do, but without the bank.
Essentially, yeah. The operational principles outlined in your sources are quite different. Elimination of central authorities, users retaining direct ownership and control of their assets by holding their own private keys.
Your keys, your crypto.
Precisely. Transparency, because transactions and code are often public on the blockchain. And accessibility, because anyone with internet and a wallet can usually participate. It's permissionless. No gatekeepers.
In your materials mention the concept of composability, sometimes called money Legos, where different DeFi protocols can be combined to create new services. Sounds interesting.
It is. It allows for rapid innovation. It also enables intermediary-free trading on decentralized exchanges, DEXs, and ways to earn yield, like lending out assets or providing liquidity.
Something else your sources explored is the tokenization of real-world assets, RWAs, taking rights to things like real estate or art, and converting them into digital tokens on a blockchain. Why do that?
To make them more liquid, mainly. And allow for fractional ownership. So you could own like a tiny piece of a building or a painting.
Okay, interesting. And in DeFi lending, your materials show that collateralization is a key risk management tool, often requiring over-collateralization. So you have to put up more value than you borrow.
Often, yes, because the assets being borrowed against are so volatile, it's a buffer against price drops.
Got it. Now, one limitation your sources point out is that Bitcoin's original base layer isn't designed for the complex smart contracts needed for many DeFi applications.
Exactly. It's great for secure value transfer, rock solid for that, but not for running intricate lending protocols directly.
That's where Layer 2 solutions and sidechains come in, as your materials describe, to enable DeFi on top of or alongside Bitcoin, sort of building extensions.
That's a good way to think of it. Solutions like the Lightning Network for faster, smaller payments, Stacks, which allow smart contracts that settle on the Bitcoin blockchain, RSK, which is a sidechain compatible with the Ethereum virtual machine, but uses wrapped BTC.
Wrapped BTC, like Bitcoin represented on another chain.
Yeah,
Okay.
essentially. Or the Liquid Network for faster, more confidential transactions and asset issuance. Different approaches to add functionality.
The aim with these, as your sources highlight, is to enable things like self-custody asset management, new asset issuance, atomic swaps, direct crypto-to-crypto trades without an intermediary, P2P lending, DEXs, DAOs, NFTs, and stablecoins, all while leveraging Bitcoin's fundamental security as a settlement layer. So get the best of both worlds.
That's the goal. Use Bitcoin security, but add more complex features on top.
This brings us to a key distinction your sources make: the difference in ambition between original Bitcoin and the broader DeFi movement.
Right. They aren't quite the same animal. Original Bitcoin, as your sources present it, was primarily focused on being peer-to-peer electronic cash and maybe a store of value like digital gold.
Simple, elegant idea.
Yeah. DeFi, on the other hand, is trying to build a full ecosystem of financial services. It's much broader in scope.
So DeFi allows for things like lending, borrowing, sophisticated trading strategies on DEXs, yield farming, even insurance products often accessible to anyone, anywhere, without requiring bank accounts or credit history, and potentially with lower fees and faster transaction times than traditional systems. That sounds revolutionary.
It has that potential. Your sources emphasize that DeFi's principles of accessibility, direct user control, transparency, and rapid innovation represent a qualitative leap from just P2P cash.
And the trend your sources identify as Bitcoin DeFi shows a desire to combine Bitcoin security with the broader utility of smart contracts and DeFi applications. It suggests a potential future where different blockchain ecosystems may be specialized or complement each other.
Yeah, maybe not one chain to rule them all, but different chains doing different things well.
Okay, so we've looked at the systems themselves. Now, pulling from your sources, what does all this mean for you? What's it like to actually navigate these financial realities from an individual perspective?
In the traditional system, as your sources describe, your interactions are common. Borrowing for big purchases like a home or using credit cards, lending when you deposit money in a bank account, investing in markets via brokerage accounts. Your access points are those familiar institutions: banks, brokers, payment apps. Pretty standard stuff.
And the regulators we discussed earlier play a direct role in your life, as your materials explain. The Fed's decisions impact the interest rates on your mortgage or savings. The FDIC ensures your deposits up to a limit, reinforcing confidence in the system. The SEC tries to protect you as an investor by ensuring fairness and transparency in the markets you use. They're supposed to be looking out for you.
Right. And a significant goal within traditional finance, highlighted in your sources, is financial inclusion, ensuring access to affordable financial products like accounts, payments, savings, and credit. It's widely viewed as critical for poverty reduction and boosting prosperity. Your sources often position simply having access to a transaction account as a vital first step.
But your materials also point out the challenges to inclusion. Persistent disparities based on income or gender, the hurdle of moving from simply having access to actually using formal financial services.
Yeah, access isn't enough.
Right. Significant gaps in formal savings and borrowing, particularly for small businesses, and ongoing consumer protection risks. It's not a perfect system for everyone.
Definitely not. Trust in traditional finance, as explored in your sources, is largely institutional. It's actively managed through legal frameworks, market reputation, culture often called the trust triangle. Your materials note that public trust is absolutely vital, especially during crises, but it's also inherently vulnerable. It can break.
And the psychological impacts are profound, a key theme in your sources. Pervasive financial stress, worrying about debt, job security, or just meeting basic needs is strongly linked to mental and physical health issues like anxiety, depression, sleep problems. It really weighs on people.
Massively. Your financial situation and decisions directly shape your emotional state, your sense of security, and your feeling of control. Your sources also connect the complexity and perceived instability of the traditional system to this stress, noting how many people feel a distinct lack of direct control over their financial lives within it. Like you're just a cog in the machine.
Now, turn to Bitcoin and DeFi.
Yeah.
Your sources present this as offering a potentially very different path. What's the promise there?
The promises are highly attractive, as your materials convey. Autonomy, financial freedom, direct control over your own assets without needing permission from a bank, enhanced inclusion for the underserved by bypassing traditional hurdles. It's permissionless access for anyone with internet and a wallet. Sounds great on paper.
It's the trustless paradigm your sources describe. Trust is placed in cryptography and the network's consensus mechanisms, not in a specific institution. Transparency is inherent on the public ledger, and immutability means records are hard to change. Smart contracts can automate agreements, reducing the need for intermediaries.
However, and this is a crucial point your sources emphasize, this autonomy comes with a significant increase in individual responsibility. You are the custodian of your private keys.
That's the big one.
Yeah. If they are lost or stolen, your funds are typically gone, irreversibly. There's no central authority, no customer service line to call for recovery. You're on your own.
You become solely responsible for understanding the risks, carefully vetting any protocol or platform you interact with, and protecting yourself against scams and phishing attempts. As your sources put it, autonomy is tied to a greater burden of diligence. That's a heavy lift.
It really is, and the psychological impacts in this space are a stark contrast, a fascinating exploration in your materials. On one hand, there's empowerment from having direct control and a sense of self-sovereignty. People feel in charge.
Right. But
the extreme volatility of crypto assets can cause immense anxiety and depression, especially during market downturns. Watching your savings evaporate overnight, that's tough.
your sources even draw parallels between crypto trading and gambling, noting the potential for addiction-like behaviors, compulsion, withdrawal effects. The 247 nature of the markets can exacerbate these tendencies. It never stops.
Never. There are also security misconceptions your sources address. While the underlying blockchain might be robust, the services and platforms built on it can be vulnerable to hacks.
So the chain is safe, but the apps aren't always.
Exactly. Protecting your private keys is essential, but your materials highlight that interacting with a compromised platform is also a major risk. Traditional security, like 2FA, plays a different, often limited role compared to the fundamental importance of private key ownership in this world. It's a different security mindset.
And beliefs about this new system are constantly being shaped, your sources note, by the inherent uncertainty about its long-term viability versus the optimism driven by the technology, the promise of freedom, and the appeal of escaping traditional trust issues. It's a roller coaster sentiment.
Absolutely. So pulling this together, your sources paint a picture of a complex psychological landscape. The autonomy offered is highly appealing, but it introduces a whole new set of stressors. The constant anxiety of volatility, the vigilance required for security, and the heavy burden of self-custody.
Right.
The democratization of finance in this realm means the democratization of direct exposure to significant risk and the associated psychological weight.
It's a profound trade-off, highlighted in your sources. Frustration with the opacity and institutional reliance of traditional finance versus the anxieties of navigating a volatile, less regulated, and highly individualized risk environment. Pick your poison almost.
Yeah. There are stresses either way, just different kinds.
Okay, so given the complexity of both these systems, where does AI fit into understanding and navigating all this, according to your sources? How can it help?
Your materials present AI as a potentially transformative force in finance, both for understanding and maybe improving things.
How so?
It's positioned as a powerful lens for understanding complexity. AI can analyze the global interconnectedness of traditional markets, the rapid innovation in DeFi, model financial stability, analyze market dynamics, and even simulate the behavior of participants, trying to see the whole picture.
Your sources give examples like AI predicting debt repayment likelihood, forecasting investment returns and risks, automating aspects of regulatory compliance.
Yeah, and even using large language models like generative AI, specifically ChatGPT 4.0, was mentioned to simulate scenarios like the adoption of central bank digital currencies, CBDCs, and provide insights for policymakers. That's pretty advanced modeling.
But your materials are also clear about the challenges AI brings, the potential for black box models where decisions are hard to understand.
Right, the AI says no, but you don't know why.
Yeah. Issues with data integrity and bias, limitations in predictability, and overall transparency problems. It's not a magic bullet.
Not at all. Yet your sources emphasize AI's unprecedented capability to model systemic risks, like contagion effects spreading through the traditional system, or understand the impact of novel instruments in crypto at a granular level. It's seen as a potential tool for enhancing both stability and regulation.
Which is precisely why explainable AI, or XAI, is highlighted as so critical in your sources, particularly in finance. It directly addresses that black box problem. It needs to be understandable.
Absolutely. Making AI's decisions interpretable is presented as non-negotiable for building trust, meeting regulatory requirements, and ensuring meaningful human oversight. Your sources mention techniques like ESHIP and LIME that can show how specific factors, like your income or debt history, contributed to an AI-driven loan decision, peeking inside the box.
This is vital for compliance, for example, being able to provide the specific reasons for denying credit under the Fair Credit Reporting Act. You have a right to know.
Exactly. It's also crucial in fraud detection, where XAI can highlight the specific attributes of a transaction that flagged it as suspicious. Not just suspicious, but why.
Your sources show how XAI also supports risk management by helping to visualize the potential impact of variables like interest rates or geopolitical events, aiding adherence to standards like Basel III, and being essential for debugging AI models and ensuring they align with ethical guidelines. Your materials portray XAI not just as helpful, but as a prerequisite for the responsible deployment of AI in finance. Can't really use it safely without explanation.
Seems to be the consensus in the materials, yeah. AI is also presented in your sources as a sophisticated weapon in the ongoing fight against fraud, operating in both traditional and crypto realms.
Okay, how does AI fight fraud differently in each world?
In traditional finance fraud detection, your materials show how machine learning algorithms are used to analyze vast data sets, identify patterns of suspicious activity, and flag or block transactions in real time, often requiring additional authentication steps. They use predictive analytics to spot deviations from normal behavior and unsupervised learning to identify entirely new types of fraud threats, learning as they go.
Your sources highlight the advantages this offers over older methods. Vastly improved pattern recognition, scalability to handle massive transaction volumes, real-time response capabilities, and potentially lower rates of false positives. Sounds good.
Oh, yeah.
The main challenge noted is the heavy dependency on large amounts of high-quality data to train these models effectively. Garbage in, garbage out.
Precisely. Now, in the cryptocurrency space, your sources explain that the pseudonymous nature of blockchain transactions presents unique challenges for fraud detection, making AI absolutely critical. It's harder to track people directly.
So how does AI work there?
Your materials provide examples. Blockchain transaction monitoring tools, like those from companies your sources mentioned, such as Chainalysis, use AI to identify unusual patterns, trace the flow of funds, and link illicit addresses to known scams, hacks, or money laundering operations. Your sources referenced the Plus Token scheme as an example where blockchain analysis aided in tracking funds, following the digital trail.
Ah,
AI is also used, as your sources show, to analyze trading behavior on exchanges, to spot market manipulation, like pump and dumps or wash trading, and to identify malicious trading bots. Natural language processing, NLP, is used to scan social media and forums for keywords indicative of scams.
reading the chatter.
Yeah. AI powers the Know Your Customer, KYC, and anti-money laundering, AML, checks on centralized crypto exchanges using facial recognition and document scanning. And specialized AI tools are used to audit smart contracts for vulnerabilities before they were deployed, with companies like MythX and Certic mentioned in your sources, trying to catch bugs early.
But your materials also detail the challenges. Fraud techniques in crypto evolve rapidly. There are significant privacy concerns raised by extensive blockchain monitoring.
That's a big one.
Regulatory frameworks are still developing, and false positives remain an issue. This leads to a crucial tension highlighted in your sources. AI introduces a degree of centralized monitoring and potential de-anonymization into systems that were partly designed to offer pseudonymity, creating a conflict between privacy ideals and the need for security and compliance. Big trade-off there.
Huge tension. You want privacy, but you also want to stop crime. AI is right in the middle of that.
Beyond systemic analysis and security, your sources show how AI is poised to reshape your individual interaction with finance, holding potential for personalization, enhancing financial literacy, and promoting inclusion. How could it change things for me?
Your materials explain how AI can build a comprehensive 360-degree profile of you from your transaction data, stated goals, and other information to deliver hyper-personalized financial products and advice.
Like really tailored stuff.
Yeah. Predictive AI can anticipate significant life events, like needing a car or planning for retirement, and proactively offer relevant products like a car loan or a savings plan tailored to those milestones. Knowing what you need before you do? Almost.
Okay, could be helpful
Yeah.
or creepy.
Both, potentially. Robo-advisors, driven by AI, provide automated investment advice and portfolio management at a lower cost, making sophisticated investment strategies more accessible. Even in DeFi, your sources describe AI-powered decentralized applications, DApps, that can automatically adjust lending rates or optimize strategies for earning yield based on your specific preferences and risk tolerance.
Your sources highlight the clear business case for providers. Increased revenue through better targeting, higher customer retention, greater operational efficiency, and a competitive edge. Makes sense for them.
AI also offers significant potential for enhancing financial literacy, making complex concepts more understandable, which your sources discuss.
Also,
Interactive AI platforms can guide users through fundamental financial principles. Virtual assistants and chatbots, like one mentioned being used by the Financial Services Agency, FSA, can answer questions and help you navigate processes. Generative AI can even summarize complex financial documents into easily digestible formats. Your materials suggest this can empower individuals to make better, more confident financial decisions. Less jargon, more understanding.
that would be nice. And critically, AI is presented in your sources as having the potential to promote financial inclusion by overcoming traditional barriers that exclude people. This seems really important.
It really is. One powerful example your sources give is alternative credit assessment. Instead of relying solely on traditional credit history, AI can analyze non-traditional data, like phone usage, utility payments, online behavior, or even psychometric data to assess the creditworthiness of individuals who have little or no formal credit history, thin-file individuals.
So people without a credit score could actually get a loan.
Potentially, yes. This can unlock access to credit for millions previously excluded. AI can also reduce costs for financial service providers by automating tasks like customer onboarding, routine customer service inquiries, and transaction processing, making it more economically viable to serve lower-income clients.
Your sources show how personalized, accessible products can be tailored for underserved groups, Migrants, farmers, women, the elderly offering things like microinsurance or small savings products, and digital payment platforms, often enhanced by AI for security and user experience, reduce reliance on cash, which is a significant barrier in many areas.
But, and this is important, your sources are careful to highlight the dual potential here, though. AI can genuinely democratize access to financial advice and credit, but it also carries the risk of algorithmic bias and exclusion if not carefully designed and monitored.
So it could accidentally discriminate.
They could, yes. Without ethical guardrails and thoughtful governance, AI could potentially widen existing disparities rather than close them. Needs very careful implementation.
Financial systems, as your sources make clear, aren't just abstract economic machines. They're deeply embedded in society and influence everything from culture and the environment to our beliefs and the very human struggle. Let's talk about that broader impact. Culture and arts first.
Sure. In the realm of culture and the arts, your sources highlight the impact of traditional finance through what's termed financialization. This involves the consolidation of creative industries and treating art primarily as content or intellectual property, IP to be monetized.
Everything becomes a product.
Kind of. Your materials bring up the concern that this can lead to a flooding the zone with shit, a focus on quantity and marketability over creative depth and quality. Even counterculture can be co-opted through corporate patronage or satire that ultimately stays within the status quo. Nonprofits also rely heavily on traditional financial structures like loans and grants.
Decentralized finance, as explored in your sources, offers alternative models. Direct artist-to-collector sales using Web3 technologies can bypass traditional intermediaries like galleries or labels. NFTs, non-fungible tokens, offer verifiable digital ownership and provenance.
And smart contracts can automate royalties back to the creator on secondary sales. That's a big deal for artists.
Yeah. Tokenization and fractional ownership can democratize investment in expensive art or collectibles, creating liquidity. And DAOs, decentralized autonomous organizations, can enable collaborative funding and governance models for creative projects, potentially challenging traditional gatekeepers, new ways to fund creativity.
But your materials also point out the challenges with these new models. They can create new forms of exclusivity requiring crypto literacy or technical know-how. They can be prone to speculation, mirroring traditional market bubbles.
Same speculative frenzy, different asset.
Sometimes, yeah. And they still face technical barriers like fluctuating transaction costs, gas fees. So it's not a utopia.
Okay, what about the environment? That's a huge topic.
Huge. Your sources demonstrate that both traditional and decentralized finance have substantial, albeit different, impacts. Traditional finance is a major contributor to financed emissions, funding fossil fuel projects to the tune of trillions, even after climate agreements like the Paris Accord.
Wow, trillions.
Yeah. There's also a risk of greenwashing, where financial products are marketed as sustainable without genuine environmental benefit. Your materials also touch on the financialization of nature itself, creating commodities out of things like carbon offsets or biodiversity, which carries risks of privatization, displacing local communities, promoting deregulation, and oversimplifying ecosystems in ways that can lead to degradation, turning nature into another spreadsheet.
On the Bitcoin side, your sources discuss the significant energy consumption of the proof-of-work consensus mechanism, noting its energy footprint can rival that of entire countries. That's the big headline grabber.
It is. There's an ongoing debate reflected in your materials about the energy mix used by miners, whether it's increasingly renewables or primarily fossil fuels. Proponents argue mining can incentivize the development of renewable energy sources by providing a consistent buyer for power, especially stranded energy.
Using energy that would otherwise be wasted.
That's the argument. Critics in your sources argue it consumes energy that could be used elsewhere, creates significant e-waste from obsolete hardware, and that claims of incentivizing renewables can sometimes amount to greenwashing if not rigorously examined. They also note that Bitcoin's decentralized nature makes regulating its environmental impact challenging. Hard to pin down.
So a key takeaway from your sources is that neither system is inherently green, and both have substantial environmental challenges that need addressing. Your materials also suggest AI could play a role in green finance transparency, climate risk assessment within portfolios, and optimizing energy use. But note that AI itself also consumes energy. No easy answers there.
No, definitely not. Very complex trade-offs.
Now, let's delve into how these systems influence beliefs, ethics, and power structures, as explored in your sources. Trust seems central.
It is. Your materials discuss how trust operates very differently. Traditional finance relies on institutional trust in governments, central banks, regulatory bodies. Your sources highlight how this trust is fragile and has been eroded by past crises, instances of fraud, and bank bailouts, which can create moral hazard by shielding institutions from consequences.
Too big to fail.
Right. Bitcoin and DeFi offer a trustless model in the sense of not requiring trust in a specific institution, but rather in cryptography and network consensus. However, trust in this new system is also subject to shocks from extreme volatility, hacks, scams, and is heavily influenced by social networks, media narratives, and individual understanding, or literacy.
So you trust the code, but maybe not the hype.
Something like that. Your sources also mention the skepticism surrounding CBDCs, which some view as potentially introducing a new form of centralized control akin to the traditional system, fear of government overreach.
Ethically, your sources delve into the issue of surveillance. In traditional finance, KYC and AML regulations involve significant monitoring, ostensibly for preventing crime, but also enabling financial surveillance.
Knowing your customer means knowing a lot.
Yeah. In the crypto space, while there's pseudonymity, your sources show how blockchain analytics tools are becoming increasingly sophisticated at tracing activity and linking addresses to real-world identities. This raises clear privacy concerns. Although privacy coins designed specifically to obscure transaction details do exist, they are often contested and face regulatory pressure. AI, your sources note, significantly enhances surveillance capabilities in both traditional and crypto systems. More eyes, digital eyes.
Definitely. Power concentration is another ethical consideration your sources raise. In traditional finance, power is inherently concentrated in institutions and regulators, which carries the risk of abuse or regulatory capture, where regulations serve the industry more than the public.
The fox guarding the henhouse scenario.
Could be. In the crypto ideal, power is decentralized across the network, but your materials point out that new concentrations can emerge, such as in mining power pools, large token holdings by whales, or concentrated control within specific development teams or foundations. Decentralization isn't always perfectly achieved.
And responsibility is framed in your sources as a radical ethical shift in the decentralized space. How so?
In traditional finance, institutions bear legal responsibility, although moral hazard can diffuse true accountability. In crypto, there's a radical shift to individual responsibility. You are responsible for your own security, managing private keys, for vetting the protocols and platforms you interact with, and for bearing losses resulting from your own error, hacks, or scams. There are no bailouts or recourse to a central authority.
Be your own bank means be your own security guard, too.
And your own fraud investigator, yeah. It places a much heavier burden of diligence on the individual. Your sources also address the uncomfortable reality of illicit activity. Crypto's pseudonymity and global reach have made it attractive for money laundering, terrorism financing, ransomware payments.
The dark side.
Your materials highlight regulatory gaps and technical vulnerabilities that facilitate this, while also noting that blockchain's transparency can paradoxically aid law enforcement in tracing funds once they identify a starting point. It's traceable, just not always to a name.
And as your sources show, AI adds new layers to this ethical landscape. It's a powerful tool for analyzing and potentially mitigating issues like bias or fraud. But it also introduces new dilemmas around algorithmic bias, leading to unfair outcomes, heightened privacy risks through enhanced surveillance, and accountability issues when AI systems make errors with significant consequences. Who's responsible when the AI messes up?
That's a huge question, still largely unanswered.
This leads us to perhaps the most profound point in your sources. How these financial systems interact with fundamental human struggles and misfortunes, the dynamics around addiction, exploitation, greed versus truth and faith, and ultimately life itself. This gets deep.
It does. Your materials reveal how both traditional and decentralized systems, while intended to facilitate prosperity, can also exacerbate human struggles. Traditional finance contributes through systemic inequality, debt cycles that trap individuals, pervasive financial stress impacting health, and the psychological toll we discussed earlier.
The daily grind wearing people down.
Yeah. Crypto, while promising freedom, introduces its own vulnerabilities, the volatility anxiety, the potential for addiction like trading behavior, the amplification of greed through speculative bubbles, the risk of scams, and that heavy individual burden of navigating constant security threats and potential losses. New system, new stresses.
Your sources highlight how emotional responses, from elation to despair, are intimately tied to financial outcomes and perceptions of fairness within these systems. Access to basic needs, health, food, rest, a sense of satisfaction is fundamentally impacted by financial security.
The historical human drive for a wealthy healthy, the pursuit of resources to relieve pain and secure well-being is powerful. But your materials show it's a double-edged sword. The pursuit of wealth detached from broader well-being often creates negative externalities like inequality and systemic crises. More money doesn't always mean a better life for everyone.
Your sources suggest that AI's capacity to model these complex systems could potentially help us foresee the negative consequences of purely wealth-driven innovation by perhaps incorporating metrics of well-being and sustainability into the design and regulation of financial systems, using AI for good, essentially.
That's the hope expressed in some of the material, yes. To build smarter, maybe even wiser systems.
So, as we look towards the path forward, your sources make it clear that navigating this immense complexity requires thoughtfully integrating technology with deeply considered ethical principles. It's not just about the tech.
No, far from it. Your materials highlight the potential for AI-driven improvements, using AI to demystify system complexity, from market dynamics to regulation, employing XAI to provide transparency in decision-making, leveraging AI for public education and financial literacy through personalized learning platforms and helpful chatbots.
They suggest AI can aid in designing better systems, using fairness-aware machine learning to identify and mitigate bias for more equitable access to credit and services, employing RegTech powered by AI to streamline compliance burdens, optimizing resource allocation for sustainable goals, and even potentially using AI within decentralized governance structures like DAOs to help analyze proposals and voting patterns, using AI to make the systems themselves better.
Right. Ultimately, your sources argue AI can make individual financial life easier by automating tasks like budgeting, payments, investing, potentially reducing stress and improving well-being by augmenting human capacity rather than replacing human judgment entirely. Helping, not taking over.
But your materials also present crucial ethical imperatives that must guide this path. A central question is, who benefits most? That seems key.
It's huge. There's a real risk, your sources warn, of an AI divide, where the benefits of advanced financial AI accrue disproportionately to large institutions, tech giants, wealthy individuals with sophisticated trading algorithms, or advanced nations, potentially concentrating power and wealth and widening existing gaps if not intentionally designed against. The rich get richer, powered by AI.
Your sources raise a critical point about the need for humanity in these systems. AI excels at efficiency and scale, but it lacks empathy, nuanced judgment, real-world context, qualitative reasoning. Can't code empathy.
Not yet, anyway. There's a danger, your materials caution, of creating mechanistic systems that ignore human nuances, ethical consequences, or fundamental values. It's essential to balance AI efficiency with meaningful human oversight and judgment, ensuring these systems serve human needs and well-being, rather than becoming ends in themselves. Keep humans in the loop.
And we must confront the reality of human cruelty and indifference. As your sources acknowledge, systems can be exploited by those who lack ethics, engaging in fraud or exploitation. This links back to aspects of psychopathology or pure self-interest.
Systems can enable abuse if safeguards are weak, whether it's crypto anonymity, facilitating illicit activities, or traditional finance complexity enabling sophisticated fraud. The challenge, your sources imply, is building systems that are resilient against misuse, guided by malicious intent, designing against the bad actors.
So in conclusion, your deep dive into these sources reveals the fundamental contrast. Traditional finance centralized, relying on intermediaries and regulation, focus on managing stability, but prone to concentration and stress-inducing complexity.
Versus Bitcoin and DeFi decentralized, relying on crypto and consensus for trust, offering individual control, but marked by volatility and high individual risk burden.
And AI as a powerful force offering unprecedented capabilities for understanding and improving these systems, but simultaneously introducing critical challenges around bias, privacy, and accountability, a double-edged sword.
Very much so. Ultimately, what your sources emphasize is that technologies like blockchain and AI are powerful tools, but their impact is not predetermined. It is shaped by human choices, values, and governance.
We're still driving the bus.
We have to be. We cannot and should not outsource the future of our financial well-being entirely to algorithms. It requires continued human agency, analysis, discourse, and ethical oversight.
As your sources movingly reflect, financial structures are fundamentally human constructs. They're designed to mediate access to resources within the finite span of human life and facilitate well-being. Their direct relevance, in a sense, fades with death, but their legacy profoundly shapes the world for future generations.
Yeah, the experiment of life itself, your materials suggest, hinges on access to resources and security provided or denied by these very systems. It's fundamental.
The quest for better systems, reforming the traditional, innovating the decentralized, intelligently applying AI is ongoing. We keep trying to build better mousetraps.
We do. And the core challenge, as illuminated by your sources, is ensuring this quest is guided by a conscious understanding of the deep links between finance, core human values, and both individual and planetary well-being.
Right.
A truly conscious financial future means building systems that are recognized as means to a better life, not ends themselves. Systems that genuinely serve the goal of a richer, more equitable, and sustainable human experience.
This exploration has given you a deeper look into the fundamental forces shaping value and exchange in our world, and how technology is rapidly changing the equation, all drawn directly from the materials you shared. Hopefully, a lot to think about.
Definitely. And here is something to ponder, drawing directly from the insights in your stack. Given that financial structures, whether traditional or decentralized, are ultimately human constructs designed to mediate resource access during the finite span of human life, and that AI offers unprecedented power to analyze and reshape these systems, how can we ensure that the pursuit of wealth and efficiency doesn't inadvertently lead to systems that undermine the very quality life they're meant to support, especially as AI adds new layers of complexity and potential bias?
And what does it mean for the experiment of life itself, when the systems governing survival and well-being become increasingly automated and potentially less tethered to human empathy and ethical oversight? Big questions to leave you with.
This is DigitView.